Welcome to Full Speed Ahead. I'm Craig Fuller, here from lockdown outside of Chattanooga, Tennessee. It is a very special Full Speed Ahead. I'm in house arrest. Matt, you are also on house arrest. Matt Silver is the founder of Forager, which is involved in cross-border transportation. Matt, welcome to Full Speed Ahead, house arrest style. How you doing?
I'm good. A little stir crazy being in the same house every day, or the same apartment rather. And my one coworker that shares an office with me is Meatball, our dog, and then my wife's got a separate office in here, so it's a little tight, but it's good.
Now, you have been on lockdown or away from the office for how long?
We moved everyone remote on, I think, March 12th. So a week and a half ago, roughly. Pretty smooth transition, relatively speaking. People are getting stir crazy being at home every day, but we're keeping kind of the cultural side of things alive with virtual happy hours and just getting on Zoom and on Slack a lot.
How does virtual happy hour work? You all get together and have a beer and just shoot the shit?
Yeah, everyone jumps into a Zoom room. You can add a lot of people in one room at a time, and we invited a couple outside people the first time that we did this. It was fun. It starts off with maybe 20, 25, 30 people, which we have about 35 people right now total, or getting closer to 40. But starts with most of the people, and people stay and they keep pouring more drinks, and then some people tail off a little bit, and maybe you share the Zoom link with one or two friends or family outside the group, and starts to get interesting. I'm going to send you a link to the next one that we do.
I got invited to my first virtual happy hour for tomorrow. One of our venture VCs is having one, I guess, for their friends and of the fund. So we'll see. That will be my first experience. We have not done that at FreightWaves. We have a slightly larger group, so I don't know how that would work, but we may have to try that. It'd be kind of cool.
I'll send it to a few of you guys if you want to join on Friday.
I'm sure JP would love to be. At times we feel like he works for the Silvers more than he does FreightWaves. It feels like, but he's like the brother you didn't know you had. So. But I want to get into a lot of stuff's happening. You and I have talked offline about a lot of the things that are taking place in freight. But you got big news this week. You guys have announced a financing, which would love to hear a little bit about that. But it's an interesting time to actually have raised capital. It seems like a lot of VCs are pulling deals and term sheets and basically reneging on some of the agreements. I'd love to hear what that process was like for you guys.
Sure. So we started the process a few months ago. Our financing to date has been strategic initially with TFI, and they're based up in Quebec, and we were going to Florida and New York for those conversations. You've got Chicago Ventures coming in last summer, Midwest firm. We didn't talk to any firms out west or on the East Coast for that matter at that point either. We were local. And so starting off the process at the end of last year, starting to go out to the Valley and out to New York and to have some of these conversations, just kind of a get to know you process initially, but kind of like speed dating. It's like 4 or 5 meetings a day and you're just churning through telling the same story over and over again. By the end of it, we got to the point where it started to narrow down and we started to find the right people that we really enjoyed talking to, and ultimately landed on USVP a little bit ago that we decided to move forward with. And the process came together pretty quickly. They came and met with us, met our team, saw our office while we still had a physical office, and it put us in a good position to really start growing. And so USVP is the firm. They're leading. It's a $10 million round. Chicago Ventures is participating, and Soma Capital is as well. And so we've got, with USVP, you get a team of engineers and doctors, to be quite honest. They focus on two core investment strategies. One is on IT or enterprise software, and one is in healthcare. And so they've done a couple other deals with Chicago Ventures previously, and there's a great relationship between our new board member and our existing board member. And so it makes for a really, really exciting time to be able to close out this round and to be able to start putting kind of all the pieces together that we've been trying to do.
And this is U.S. Venture Partners, which based in the Valley, and they put, you said $10 million?
Yes, they're leading with a $7.5 million check, and the rest of the round is filled out with Chicago Ventures, Soma Capital, and a couple other smaller investments.
As an early stage company, you guys have some revenues, but you're still in the, was this a Series A? Is that what you guys are classifying it as?
Yeah. So
what is that like right now with COVID-19 lockdown? What is that like?
Okay, so when it comes to kind of the raise process and everything, and with what's going on with coronavirus, first of all, we went out with a year's worth of business. We've added a lot of enterprise customers, a lot of middle market customers. We've got revenue. We've got a business that's moving. We've got a process, and we've got technology. And the technology that we have has product market fit. There's people using it. And so the initial part of these conversations, people are trying to differentiate between us and some of the other logistics tech companies out there that we all know, like an Uber Freight or a Convoy or a Transfix. And we navigated through those questions, and we are truly building something that's a lot different than what those guys are doing. But when it came down to what's going on with coronavirus, there was the initial questions that came up were what was going to happen to our business, and how are we going to survive that, and how are we going to deal with all of that. And first off, the concerns were around what was coming out of China at the time. So everybody was worried about shipments coming from China to the U.S. We're not doing drayage. We're not doing anything in the U.S. and domestic. And so a lot of our freight wasn't really impacted by the initial part of this whole thing. And we didn't see a drop in volume. More recently, over the last few weeks, obviously, as things hit the U.S. and hit kind of a global scale, we started to see a little bit of volume shift, and we started to see our automotive stop over the last week. And so some of our automotive customers have stopped for at least the next few weeks, potentially the next quarter. But on the other side, we've got some food and beverage customers that have significantly increased the number of shipments that they're shipping out of Mexico and Canada, to where we're seeing our concentration on industries have shifted significantly kind of during this whole process.
So Matt, is this, I've had a number of conversations. There seems to be a lot of disagreement and confusion, a lack of awareness. The historical models are completely breaking down right now for anybody. And really it's anybody's guess as to what the next week or the next couple of weeks hold. But we saw massive amounts of volume in our sonar data, which tracks the broader market. We've seen massive amounts of just freight moving through the system. The question's going to be what happens in a few weeks. And I'd like to get your perspective. Do you think that volumes are going to drop significantly? Are you bullish? Are you bearish? Where's your head at right now in terms of what's going to happen, say, in mid-April?
The volume's going to keep going up for certain industries, and it's going to be dead for other industries. So, like the products that people don't need to buy right now, like TVs, washers and dryers, some electronics are going to slow down or completely come to a halt. Automotive is stopped right now. All the major OEMs have already announced that they've shut down. They may start building, respirators and masks for manufacturing those for what's going on right now. And so we could see a volume uptick from those shippers, but their sourcing is going to be from different spots than where they're normally buying product from. Food and beverage, keeping grocery stores stocked, are going to continue to grow up. So I think volume is going to go up in general with what's going on, or more importantly, I think capacity will tighten because we'll see drivers that are going to start to get sick potentially. We're going to see certain drivers that don't want to go to certain parts of the country. We've had a lot of carriers recently say that they don't want to deliver freight to California right now. And I imagine a lot of carriers don't want to go into New York right now. So there's certain areas that they won't go into. Pennsylvania, shutting down those truck stops causes a lot of issues for capacity. So volume is going to go up. You guys have a way better insight into volume with sonar. I would say from the capacity standpoint, though, it'll just tighten because of the fear that's going on right now.
Yeah, I'm going to make prediction. This is March This will be March 27th in 2 days when this is published on Friday. So I can be held to these predictions because I'm time stamping it right now. My prediction is April, we're going to see a significant drop off in freight. I mean, the part that concerns me is 40% of the economy is completely shut down. Manufacturing, autos, aircraft is a big piece of it. Even the energy markets, in terms of any speculation for oil well drilling, chemicals, all the industrial goods are basically going to zero. Retail, except for e-commerce, as you mentioned, certain retail items, people aren't buying washing machines and other things. So I think we're going to see a significant drop off. My prediction is right now we're at the OTVI index, which is our volume index, is over 12,000. I think it's going to drop below 9,000 by mid-April. That's my prediction. We'll see if I'm right, and we'll see if I'm wrong in terms of whether volumes increase. So that's the bet for today. But I want to get into, what does this all mean? We've seen significant changes. You're working from home, I'm working from home. I guess the question is, if this is a longer term shutdown, then society does start to change. It becomes more permanent because people get used to these things. But I'm wondering, what is your prediction for, the next year, sitting right here in terms of just what do you think is going to happen?
So I think I'm going to take this to talk about technology, to talk about the world in general and not specifically logistics for a second, although it does also touch on logistics. I think there's going to be a lot of M&A in general. We're going to see businesses that are going to collapse or just at this point, they're going to have to shut down. There's certain companies that will be able to survive this. The logistics industry as a whole is pretty resilient to recessions. Everybody still needs the stuff that's shipping right now. And even with your prediction about the volume dropping, a lot of 3PLs, a lot of trucking companies will live through this. We already saw Anthem get acquired by Blue Grace recently. Costco just acquired Sears' logistics business. We might see other big box companies or some of these other big shippers buy a logistics company at some point in the near future. Maybe Amazon goes and scoops someone up like Lyft. Maybe Amazon could go get Lyft and take all of their drivers and convert their drivers that are doing normally moving people around, and all of a sudden you have all these people that don't want to leave their house. Maybe all those drivers become delivery drivers for Amazon, and they're delivering packages and they're delivering groceries. And it turns into kind of a postal service style or a milk run style where you've got the same Lyft driver that's hitting every single one of your doorsteps to drop off your groceries and your packages for that day. So we could see some serious M&A. We'll see a lot of talent coming out of the market, which is unfortunate for the people that's happening to, but at the same time, my hope, and I'm sure a lot of other businesses like yours are hoping to be able to be a landing spot for at least some of those people. So there's going to be a lot of things that are going to change. There's going to be probably some really incredible businesses that are born out of what's going on right now. Someone's going to think about a different way to do something. Imagine if you owned stock in like Zoom 2 months ago and how that's doing right now. And Slack is doing really well because everybody's using Slack. People are using new types of technology to manage their business, to live their daily life. I'm hearing about all sorts of people that are, we're using Zoom internally with work and for external conversations with customers, but we're also, I'm hearing a lot of our people are using it to talk to their families. So there's going to be new businesses that I'm kind of excited to see what comes out of it. I saw something on Twitter the other day where someone asked about how doctors can better communicate across the entire world and how they can share information, how they can cut through all of the kind of all of the mess that you see on Twitter or online that's more public. How do they get all of their information and all of the communication done in a succinct way where they can all collaborate, share information, share things that might help them solve this virus and help work together as a global team? And so what does that technology look like? Has somebody built it? If they haven't built it yet, who's going to build that?
There is some upside in government regulations. There's a desire by government rightfully so to get rid of some of these burdensome regulations. Teledoctoring, telemedicine was even though it was allowed, there was a lot of regulations that they had to contend with across state borders. A lot of insurance companies, some would offer, so others didn't. We're seeing that go away. We're even seeing things like alcohol delivery, as you can get mixed cocktails delivered to your house in places like Texas, because they're trying to encourage people to stay home. One of my favorite restaurants here in Chattanooga, the freight capital, or I will say the gig internet capital of the United States. That is a fact, Matt. We're getting to that a little bit later, is whether Chattanooga is going to win out in the work from home revolution. I think it does. I think it beats Chicago. We'll talk about that in a minute. But before we do, there is a restaurant in Chattanooga called Aaliyah, which is if we had a 4 or 5 star restaurant in Chattanooga, we don't have as many of those here as you have in Chicago, but it's one of our finer dining places. They've started offering curbside. My wife and I, with the new baby, have not been able to go out to many dinners lately. So it's sort of nice that our favorite restaurant now is offering curbside. I hope they keep that. I hope this becomes a permanent movement. And I do think we'll start to see a shift in how people are delivered. I want to touch on something real quick. You said Amazon buying Lyft. That doesn't fit the pattern of Amazon. They tend to build things organically. They could have very well bought, a Coyote a couple of years back, or could have bought FedEx, or they could have bought any of the logistics companies, name it, C.H. Robinson, whomever. They don't buy of things that they can build. My guess is they would probably just as well build it as buy it. But we could see a lot of M&A. We could see a lot of stuff happening. I'm curious on the tech side of things, where you sit. You mentioned Convoy, you mentioned Transfix, you mentioned Uber Freight. I'm curious, what happens with the venture cycle from your perspective? These brokerage businesses that have maybe not just Convoy, but some of the other sort of second tier players out there. What happens to their businesses? Are they going to survive intact, or do you think there's going to be consolidation of the digital players?
Part of it depends on how much their investors love them, or believe in what they're doing. A lot of that does. Some of it depends on their business model. There's this whole race to the bottom that we're seeing in the U.S. market with those guys like Uber Freight and Convoy, and they have the capital to continue supporting it, especially Uber. And so, as does Convoy with their most recent raise. And so, there's going to be the smaller guys that might be close to running out of cash. They might not have enough business to live off of their actual income or their revenue. And so, yeah, we might see some smaller consolidation from some of these smaller guys, or they might run out of money. And a lot of the time, I recently heard of a startup. I don't want to name names specifically, but I heard of a startup recently that was a logistics tech company that was basically out of money, and it got to the point where they were looking for investors. They were trying to sell their company. Everyone that I heard from about that whole deal just wanted to wait until it fell apart and they could pick up their engineers and they could pick up the talented people and then not have to deal with the IP, not have to deal with paying back the investors, not have to deal with any sort of a price. So there's going to be this thought that like some companies might just wait for someone else to kind of just fall on their face and then scoop up the talent.
Yeah, I think if it's a Chicago-based company that I'm thinking of, then that went through that process. My thinking is that in that particular situation, we also start with Sikorsky or Skarsky. The autonomous trucking company, not Sikorsky, that's helicopters. Starsky, yes, thank you. We saw that as well. Is these companies don't have sufficient scale. They've ran through a lot of capital, and they don't have anything special to really buy. Maybe you can get the technology, but if it's just technology, the challenge of that is, and we've looked at M&A transactions of companies that have platforms. The difficulty there is that it's very difficult to do diligence on code, and then talk about integration. If you're just buying IP, it's just as easy as you pointed out to let the thing fail. And then you can go acquire the engineers that built it. And perhaps you can buy the source code on pennies on the dollar. But there's no point in buying something, particularly software businesses that don't have any type of distribution of scale, because you're not really buying much. There's nothing special about it.
Yeah, now that I think about it, and whether it was that opportunity or anything else, like if I had the opportunity right now to buy some smaller tech play that was doing something with, let's say it was doing something with owner ops in the U.S., the amount of time that would go into trying to integrate with that system and to try to figure out if the code lines up and to try to make all of that work when it would probably make more sense for us to just try to build that at some point if we wanted to go that route. It doesn't make sense. Now, if I were running a big freight brokerage that had no tech, that was using off-the-shelf software, and I thought there was an opportunity to pick that tech up, especially if it had a TMS within it, and it was unique enough that made sense to buy it, then yeah, that makes sense. So somebody like one of these bigger brokerages like an Echo or a TQL that doesn't really have any unique technology, for them to go, or proprietary technology, for them to go and buy a smaller digital freight brokerage, I would believe that, and I'd be intrigued to do something like that if I were in that position. But to merge tech, it wouldn't make sense.
It's very difficult because we've looked at a couple of, so we've acquired 2 companies in the past year. We've looked at, a dozen others for potential acquisitions. I've gotten close on a couple, but for whatever reason, those deals didn't close. And they're all various reasons. But I always struggled with companies that had a piece of technology that didn't scale and trying to get comfortable writing a check for those technologies because you're like, I am buying something that is not scaled, that then I'm going to have to go bring engineering talent to go rebuild. And frankly, there's not that much mystery to the business anyways. There's not a whole lot I can learn about it. Now, there was a couple of assets that were technology centric, but they had an interesting way that they were accumulating data. They had data history. There was something of interest that goes beyond just a platform. I think the platform only businesses are very, very difficult for companies your size or my size for us to buy, because we're going to have to throw a dozen engineers to help repair it when it's just as simple to start with no tech debt and start on our existing framework and sort of incorporate these features into our businesses.
Could you imagine if someone like Convoy, and I know that the dollars wouldn't line up for this, but if someone like Convoy, who has this technology where they've apparently automated the majority of booking, or at least a lot of the brokerage component of matching and pricing, if they have the 10 years of historical data that someone like Coyote has, that would be ridiculously valuable. To be able to have 10 years worth of, or 12 years of historical data of shipping, where that's already in a solid database that they could then take and transform, even if it was just to buy the data itself and potentially not the talent that came with it, but just have the data and the network and the customer base, that's got value. But just a piece of tech that doesn't have much to go with it. We looked at an acquisition really early on, and like the claim to fame was that they had $1.5 million in like top line revenue that we thought I could 10x by calling those same customers. And like, great, I could probably just go call those same customers myself without having the intro and get the business. And then the tech turned out to like basically be a bunch of free code that didn't really like scale. So
yeah,
we've been cautious about that.
Issue. I mean, I think, you mentioned Convoy or Uber Freight or anybody that's in the freight brokerages, even yourself, there is a value. I don't think this is the style. I don't know that Convoy or Dan has made any acquisitions thus far. It's certainly Uber's made a couple of small tuck-ins when they first started, but it seems to me that that's not the way that those guys have built their businesses. I think they've made the same calculation. Why pay a massive premium when you could take the same capital and perhaps buy the business and not have to deal with all the personnel and cultural issues you end up with, because the way Convoy operates their business is very different than most freight brokerages, which in many ways has helped them scale really, really quick. And it would be difficult, I think, to take a different type business model and incorporate it, where it's more people centric than tech centric. It's very difficult, I think, for them to make that leap. And I think they've already have achieved enough scale, and frankly have, as you mentioned, supportive investors that are letting them operate the business the way they operate it and scale the way they operate it without a lot of traditional pressures that perhaps other businesses would face.
I think from what I've kind of gathered in some of the conversations I've had over the last 6 months, VCs don't love M&A. They do if it's their portfolio company getting bought because it's a great exit, but they don't love using cash to just buy other businesses. Private equity is all about the roll-ups. Private equity will fully buy into a roll-up.
I'm so happy you mentioned that. That was our experience as well. So we actually have done 2 acquisitions, and we have the opportunity. I think we have 171 companies identified for potential acquisition. We're tracking both in the media space, the data space. A lot of these businesses, some are larger, but a lot of them are sub $10 million. They're like the leader in a very small niche, or a leader in, maybe it's a media outlet that covers a certain segment of transportation. Perhaps it's a data business that covers that monitors a piece of data, but they're the leader in that. And what was interesting, when we went out, we went on a road show. We went to New York and we went to San Francisco. And it was interesting. There was a very big bifurcation between what investors perceived our value was in the Valley in San Francisco, West Coast, and what investors perceived our value on the East Coast. And it was completely, it was bifurcated. It was interesting because the West Coast investors hated anything that wasn't recurring revenue. We're like, why do you have a media business? I don't get it. Like, why are you investing in this media thing? Whereas the East Coast investors, what would be viewed as late stage private equity or late stage growth, more early stage growth private equity funds, late stage investors, loved the idea of platforms. They love roll-ups and M&A, and were willing to back that. And it was interesting because our CFO, who comes from a traditional SaaS background, when we would talk to certain types of investors that were more Silicon Valley tier 1 VCs, the household names that you all know, he was like, these are the ones we should talk to. Those are the ones we performed least. He had a SaaS background. Whereas the ones that actually loved our business and loved what we were doing were on the late stage funds. But they approach business very different. The late stage funds, the private equity guys, they love M&A because it's accretive growth, but they hate high burn businesses. Whereas the West Coast guys can burn as much money as you can get your hands on, as long as your recurring revenue business is growing. So it's an interesting bifurcation between how East and West Coast investors think, I think.
Yeah, and I would imagine that specifically with your business, and we kind of saw this a tiny bit, but I would assume a lot more with yours, where like you have media, you have data, you have, I think you've got some sort of subscription model, you've got the events, like those are all different types of revenue streams, and I'm assuming you get different types of credit for that, and people start to run through like what's worth what, and it's like you just sum it all up, and it's like, we'll do $100 million, and they're like, okay, what is like maybe 30 of it's one and 20 is another. Like they just break it down.
It is interesting. I think it's easier for most venture investors to basically wipe out the non-recurring revenue businesses. So they basically, when they look at valuing our business, they say what's truly subscription. So Sonar is our SaaS business. They can put a value on that, and maybe it's a 15 or 20% multiple will give you sort of benefit. Maybe it's a 10. Depends on the perspective of an investor. I think the ranges on SaaS are like the lowest I ever heard was on a fast-growing SaaS business was 8, and the highest was over 20 of revenue if you're growing really fast. The problem is you're not getting credit. We didn't get credit for our media or events business, which are both profitable. The SaaS business is not profitable, and it's not really profitable. So it's interesting how investors sort of perceive things. But if you go to a late stage, household name private equity fund or a big bank that everybody in America knows, they love this sort of cohesive ecosystem, and they're okay with M&A. In fact, they love M&A because they can view it as accretive. They're not okay with high burn. But if you go to the West Coast, it's all high burn. You can burn millions of dollars, and they don't blink an eye as long as your recurring revenue is there. I think it's interesting because there are businesses in this space which are not truly recurring revenue businesses, but have traded at recurring revenue multiples. And I wonder if we don't see a reset of that. I don't know what your thoughts are there.
It's going to be, there's more of a focus on profitability right now, or at least understanding the path to profitability from VCs. There is going to be a big reset in terms of valuation on everything. Like I heard, and you touched on this at the beginning of the call or the video, there's the refactoring of valuations in the middle of a deal. There's people pulling term sheets right now. When we come out on the other end of this, I'm really curious as to how people are going to value a business or how they're going to look at something. And so they're going to go and look at someone like us. And let's say we don't quadruple our revenue from this year, which like if this doesn't happen, if we don't go into a recession, like maybe we do get close to quadrupling our numbers. But let's say that doesn't happen, but we do build our tech, and we build our tech twice as fast as we would have previously if we were spreading our resources across product and engineering and sales and marketing and the supply side. And so if we kind of reallocate that the capital to the tech side and our tech advances, and we achieve more milestones on tech, but maybe our revenue number doesn't go quite as high, do people go and look and say, why didn't you do that from year to year? There was an article that was just posted, I think on CNBC, from one of the partners at Emergence Capital, who has done a little bit of investing in this industry, and I think in P44. And it talked about the fact that partners are telling their investments, like, hey, worry about surviving this year. Don't worry so much about what your numbers look like. And so I'm curious as to like how people value things after this, because you know that right now, especially early stage, when a VC thinks about how they want to value a startup, whether it's pre-seed, seed, Series A lot of the time right now, it's like, okay, I want to invest X amount of dollars. I want to own this percentage of the company. So that tells me what the total value of the company is going to be after the round closes. Whereas when a company gets acquired, they do the math based on the value of what their business is built, how much revenue they have, what their EBITDA is. Like they look at all of that. And so maybe things get a little bit closer from like the valuation like this to the EBITDA based valuation, and things get a little bit closer. But I'm not the expert on valuation on that side of things at all.
I think as you get into the alphabet, you go from A to B to C or whatever, then the numbers do get a bit more rational. Even with us, when we were talking about later stage capital, they, like you described, they were taking the ones that did deep dive into the analysis would actually value segments of our business separately. So they'll put an X on events, trade it 14 times EBITDA. Media businesses trade at 7 times EBITDA, and SaaS trades at 10 times revenue, whatever the number is. And so they do put, when you get in these later stage rounds, they put potential exits of what these businesses will look like in 3 to 5 years or during exit horizons, and then determine that's what they think the business is with their own sort of discount to your numbers. That's,
Yep. And how much future investment's going to be needed? Everyone, sure. A lot of people ask, like, are you going to go out and ask for are you going to try to do a $400 million round in a couple of years to be able to go buy up all the volume in the entire network? And it's like, I don't want to leverage venture capital to subsidize our customers' transportation. I want to actually build technology that will help them save money and be creative about how we build it, what are the revenue streams we can create for the business aside from just transportation, and get really creative in terms of what we actually build. And so the answer was no to trying to go out and do a $400 million round. I might be wrong. We might do that in a few years. But like,
well, I'm going to record this and say, if you do a $400 million round, I'm going to play it back.
That's why I just said that.
Well, there you go. So mark the date. We're going to say it was interesting. You said something I wanted to dive into, which is what's happening right now. So we're in this COVID-19 lockdown. In 6 months we'll have a different perspective than we have today. It is interesting. I've heard, our board, the board that is investors in FreightWaves, as well as other investors that either I've met or known or talked to or consider friends. It's interesting to hear the take on how they're coaching their portfolio companies. I'm hearing that a lot of layoffs are on the way in tech and in freight tech. So there are certainly going to be some layoffs and downsizing. And I think the message is survival. I think, as you mentioned, right now in 2020, most of these venture capital-backed companies and frankly businesses across the whole landscape are going to get a pass. Q2 2020 and maybe Q3. I think people are going to let you have a pass. If you miss your numbers, you're not going to get scorched. Now, if you run out of cash or you start your cash burn accelerates and you don't take corrective action, you're not going to get a pass. I think right now it's all survival, as you mentioned. That's what every investor is trying to tell their portfolio companies. I did talk to an investor that told me that their entire portfolio, all of their investments, they want to see a 20% reduction in staff. This is not one of our investors; it's another investor, but they're directing their entire portfolio company to take 20% across the board reductions because they just want to survive at this point. And they're also saying the window for future investment is probably close to 2022.
Yeah, it's going to be interesting. We're definitely going to focus on conserving capital, but at the same time, when you can get A-plus talent at every position possible, it's worth making that investment. We're going to do some optimization. We're going to look at everybody that currently works at the company and figure out how we can make everyone that's currently at Forager extremely productive. And at the end of the day, there's only a few things you can be doing here. You can either be building the product or help build the product. You can be getting customers, you can be onboarding carriers, or you can help with onboarding customers or onboarding carriers, or you can help our customers. If you're not doing one of those things, or making sure that we get paid and whatnot, then there's something that we need to look at, or we need to move people around and get people into the right position. Our investors have not told us to cut people. They've told us to be cautious and conservative around how quickly we hire people after this raise and who we hire and how many we hire. It is definitely a buyer's market from a hiring perspective, but there's announcements that are happening in Chicago right now about big tech companies here that are doing layoffs. It's definitely sad and unfortunate, but it's really about keeping the burn down, but still building the product and not slowing down where we can control. At the end of the day, the thing that I've told the team, there's a couple things we can control, and there's one thing that we can't. We cannot control how much freight our customers ship. We can't go and call, name your beer company and say, ship more beer, I promise they'll drink it. You can't call the automotive companies and tell them to ship freight when they don't have any freight to ship. So you don't really have control over that. You could find more customers, but you don't have control over that. What you do have control over is how quickly you build product, how well you build it, and you can control how strong you can build out the supply side of your network. So when you come out of the other side of this, and there's all these carriers that are sitting at home or that have a little bit more time on their hands so that you can talk to carriers more often, do that. So we're going to invest heavily in product, in the team, and in the supply side of our marketplace.
Yeah, you can control your burn too. And I've been through this. I ran a business that was in payments we had good years, we had bad years, but it always felt like a struggle. We always felt like we were teetering on going under. But it was interesting because I remember in the mid 2000s, I had a friend that had a telecom company. It was in these, they call it MVNOs, which are basically buying blocks of time and reselling it for prepaid wireless. But basically, his business was never great, but he ended up doing really well because all of his competitors went out of business. Metro PCS got bought out, Boost Mobile got bought out, and he was one of these independent players and had the 7-Eleven account, and he just survived. And basically, he's like, look, I just have to survive long enough to buy all my, and he eventually became one of the biggest because he bought all the assets out of the ones that had folded. Now he bought customer distribution. In payments, my old business was very similar in that, where for many, many years, we were just sort of prodded along. It was after I left, the company's done well, but it is because it was a survivor, and now it's thriving because it's been able to get market share through some of the picked up the pieces as the markets. I think every market goes through that. And I think in freight and freight tech, particularly in the brokerage side, and maybe other avenues of freight, is there's been a lot of capital deployed. A lot of those businesses will die, will go out of business. And I think the name of the game is survival. You may not be able to scale really fast right now, or may not have to. You may be able to pick up the engineering talent, the people, the portfolio business by being a survivor, just waiting out the storm and letting some of these other guys go out. I think it's an interesting sort of a dynamic that may be in the market.
Yeah, it'll be interesting to see how people respond, how people react, and how they kind of handle everything. It's the thing is, like, with what's going on right now, this has literally never happened before. It's not the Spanish flu, it's not World War II. It's like the whole planet is completely shut down right now in terms of people being inside and staying in their homes. And like, I go and take, our dog out for a walk once, a couple times a day, and I don't see like more than 3 people. And so I'm thinking back like 2 or 3 weeks when things really started to come to pick up speed in terms of what was going on. And it was, everyone's going to go work from home for 2 weeks. And then the CDC goes, let's not have anybody of more than 50 people gather for at least 8 weeks. And then Andrew Cuomo is saying, the governor of New York is saying, it could be 9 months that we're in full isolation. And so I've told our team to prepare for this being longer, not shorter. It's why we sent everyone home with all of their equipment, their monitors, their desks. We want people to be comfortable in their work environment right now. We're doing everything we can to at least keep the culture alive. And you know, a lot of the leadership on the team have been great about working on that and focusing on that. It's you know, having those Zoom happy hours. It's having those. It's getting, you know, DoorDash credits or Grubhub credits to our employees to be able to get food delivered once or twice a week instead of like what we would normally have as breakfast in the office. So it'll be interesting to see what happens next week and the week after that. You know, there's nobody that exists in this entire world that we could talk to that's been through this before. So the only option is like to talk, like for me and you to talk about this stuff, and like me to talk to other co-founders in Chicago about how they're going through all this, and like just seeing a really kind of cool sharing of information across leadership at different businesses to figure out how to like best navigate this stuff.
I mean, we're all in it together, even if we're competitors or, you know, we're in it together. You remember how precious. I mean, the thing that always touches me or hits me is when on Twitter people say, you know, I knew someone who passed, and it becomes very real. You read these articles where, like, we're talking about life and death, and we're talking about potentially millions of people worldwide dying, and potentially even in the United States. I mean, it's a scary situation, and but it's also, you know, there is comfort in having these conversations because you can sort of laugh at the ridiculousness of all of it in some ways. But it is a very serious situation. I have also, you know, some of our employees had thought this was short term. You know, we have been, like yourself, have been impacted by it for many months. We've been reporting or tracking it. So I think we were more in tune with what was happening than most businesses, certainly in Chattanooga, Tennessee. And I've told our team, you need to plan this being at least May, if not longer, before we return to the office.
They just pushed the Olympics back. This is like.
Well, my instincts tell me it's probably going to be July, August, September before we see any normalcy. But right now, I can guarantee we're not coming back in April. Like, that's a fact. But my guess. Now, the thing that's interesting is these event businesses. You know, we were in many ways hoping because we have contracts in the city of Atlanta, so we had actually decided to cancel our event sometime in late February or early March, and we were waiting for the city of Atlanta because you know, there's a 7-figure penalty for and you can't get any of your deposits and stuff, and we have speaker contracts. So for us, it was like literally we needed the CDC to say you can't have an event for us to get refunds on all these deposits. Otherwise, we're on the hook for them. So that helped for us. But we certainly, I don't know what happens with future events. I don't know if the event business for us is going to start back in the fall. We certainly hope it does come back to normal, but who knows? This could go on for months and months.
Yeah, I'm very interested by how that's going to work, and that makes more sense as to why we saw some other events like not get canceled for a while in the industry. But I'm also curious, and
TIA actually, it was interesting. TIA's message was pretty. I don't know that I would have constructed the same message. It felt a little, but anyways, I won't go into that. But it did feel weird. But I understood what they were waiting on. They needed the city of Austin to say no, so they could also get, because you're talking about the fact, you know, these events, you typically are paying, you know, anywhere from half to 80% of your money up front, and you're on the hook for that. And you're on the hook for hotel blocks, hundreds of thousands of dollars in hotels that if nobody shows up, we have to pay for. And we don't. The problem is it's an asymmetrical risk because we're on the hook for them. We get no revenue off of it. The hotels don't share. It's just for the convenience of the people that come. But you have to have a force majeure situation to get out of it. So that's probably why you saw some of that very slow. You're like, why don't they get it? It's because they're waiting for the government.
If someone leaves here and wants to go work at any, you know, name your brokerage and wants to go be a carrier up there, like. We're not, you know, that's not something that's like super bothersome. Now, calling around and calling existing customers and saying, hey, I used to work at Forager, you should come work with me here now, like, that's where that crosses the line and it violates their non-solicit. So I think what's happening right now with these layoffs and then saying, sorry, you can't go get another job, you got to retrain and find a new industry, like, that's unfair to do to those people.
I completely agree. I like you said, going after customers, and us, first of all, I'm not worried about a dozen reporters walking out day one. First of all, it's media businesses broadly, or like, as I even learned going out to the Valley, it doesn't matter how big you are and how bad you are. It's very difficult to raise capital. They have to be profitable, media businesses, and it's just a different world. And, report. Go ahead.
The only companies that could probably steal JP away from you.
We'll let JP decide that. Although I love JP and he's one of the most brilliant people I know. The question is him so we had him. We have this product called research product called Passport, and JP has this. The problem you have with journalists, period, is they don't want to sell out, right? They don't want to do anything commercial because in their mind they're selling out. But we're like JP, we give him a hard time because him and the David, who runs our sales effort, are always sort of in conflict with one another and stuff. And so one day we're like, JP, you have to, like, we dared him to call up a friend of his to ask him to buy a passport. And he's like, oh no. And so he did it. And we're like, holy crap, JP actually sold something. This is great. So, but I can't see him being commercial ever. What makes him so good is he isn't commercial. Like he doesn't sell out. So
maybe we'll make him a sales rep or something.
All right. When all goes south, when all advertising dollars go to zero, and JP comes work for you, I want to see him as a freight broker talking to a driver wanting to haul a load across the border.
Spanish, yeah.
Using to go across the border. I'd like to see. You know what we should do? We should do we should have JP go work at a brokerage one day just to become a broker.
Yeah, it's like undercover boss.
That would be awesome, and he can write a report on his day inside of Forager.
What I would do that with one of the brokers in Chattanooga. It'd be weird with us, but get him into what's it called? Arrive's office or
Triton's there. Arrive's got an office there, so I want to put JP to work. I want to see him. We got to film that. It's like a reality.
Get him on the phone. Get him on the phone.
That's awesome. Well, look, Matt, I really appreciate it. We're about out of time. I'd like you to give me 3 predictions for 2020 on what you're predicting is going to happen, and then give me a far out prediction for 21 in terms of just like completely off the wall crazy prediction.
I mean, my completely off the wall prediction is Amazon buying Lyft. I would have said Uber, but Uber has their Uber Eats business and the freight business that are generating revenue, however negative it is. But I guess 3 predictions for this year. One is going to be that we're going to have, this is going to be one of the worst experiences a lot of people have ever had in their entire life. And we're going to see a lot of businesses fall apart, unfortunately, because of it. On the flip side, though, we're going to see some businesses that are going to move to remote and not ever come back from being remote. So that's going to tank the real estate industry. And speaking of real estate, for prediction number 2, WeWork. There's no way WeWork makes their way out of this whole thing at the end of this.
There's
dead. No way.
Community and short-term leases seems like a really bad business right now, for sure.
Yeah,
I'll second that. That was not even a stretch. You didn't even have to go very far with that one.
The third one, I think we'll see. So XPO is not going to do their breakup right now. I think we're going to see at least one really interesting, holy shit kind of acquisition happen in the industry, whether it's one of the bigger tech guys buying a smaller brokerage or a bigger brokerage buying a Transfix potentially.
Yeah, we'll see. I think I agree with most of what you said. I agree with everything you said. I'm going to be interested to see how the asset providers operate, particularly the larger folks and mid-sized carriers, because while a brokerage can always downsize people and has usually, except for rent and maybe some software services, they have very little sort of risk in the business and assets they have to deal with. Whereas the asset guys, if there's a significant downturn in April or anytime this year, there may be a lot of bankruptcies on the asset side. We've already seen that last year. I think it's going to come, and we're going to see a ton this year. So it's going to be interesting to see what happens.
So what's your big prediction for the outlandish?
I think we'll see a mega merger on the asset side, and I agree with you. I think we'll see a mega merger between managed logistics. I think we'll see a 3PL and more of an XPO type play with some asset purchases happening with a 3PL, either a 3PL buying some asset base or asset light. It's still an asset light business with some assets, or an asset carrier buying a very large sort of 3PL. It's probably the other way around because they have more money.
What about like a Home Depot or like a Home Depot buying somebody, or or a Walmart?
I've never bought that. I just don't know why you would want to own a transportation company. No, I'm just not. It is outlandish. Well, Matt, appreciate your time today. Enjoy the lockdown and stay safe.
Thank you. Talk to you soon.